Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate jargon so you don't have to. Today we're diving into a 10Q filing from MiNK Therapeutics, a company trying to unlock new cancer treatments. And let me tell you, after reading this, I think their chances of getting out of the red zone are about as good as a sunburn in Alaska. But let's see why. This report is basically a financial checkup showing how MiNK is doing. We will find out if they are making progress or simply burning through cash. Sounds like a wild ride? Then buckle up and let's get started. If you enjoy having financial reports decoded, make sure to subscribe to the channel. I will also leave a link in the description to our Discord, where you can discuss the findings in the report with others. MiNK Therapeutics filed their quarterly report, also called a 10Q, with the Securities and Exchange Commission, or SEC, for the period ending March 31, 2025. This report gives investors an update on how the company is performing. Think of it like a quarterly report card. First, some quick facts. As of May 12, 2025, MiNK had about 4 million shares of common stock outstanding. This is important because it affects things like earnings per share. Now let's look at the numbers. The balance sheet shows what the company owns and what it owes. MiNK had about $3.2 million in cash and cash equivalents as of March 31, 2025. That's down from $4.6 million at the end of last year. This means the company is spending more money than it's bringing in, which is not great. Their total current assets, which are things they can quickly turn into cash, were about $3.6 million, also down from almost $5 million at the end of 2024. On the other side, they have $12.1 million in current liabilities. That's way more than their current assets. This means they might have trouble paying their bills in the short term. Interestingly, they owe $13.9 million to related parties. This is money borrowed from people or companies connected to MiNK, and it's a big chunk of their debt. Next up, the income statement, which shows how much money they made and spent. MiNK spent about $1.3 million on research and development in the first 3 months of 2025. That is down compared to the $2.5 million they spent during the same time last year. That's a pretty big decrease, which may or may not be good depending on if they are cutting costs or had nothing to spend it on. General and administrative expenses were about $1.3 million, roughly the same as last year. Here is the real kicker. MiNK had a net loss of $2.8 million for the quarter. While this is slightly better than the $3.8 million loss last year, they are still losing a lot of money. It averages to a loss of about $1.70 per share. The statement of cash flows shows where the company is getting and spending its cash. They used $1.3 million in operating activities, which is how they run the business. They only got $576,000 from financing activities. Basically, they did not make enough money, and financing activities barely did anything. Exchange rates also chipped away a little bit. In the end, their cash decreased by $1.3 million during the quarter. Now, let's dive into the notes, which give us more details about the numbers. The notes confirm that MiNK has been losing money since they started. They expect to keep losing money until they can actually sell something and make a profit. There are potentially 84,371 shares from stock options that could be issued in the future, which could dilute the value of existing shares. MiNK relies on Agenus for a lot of its operations. They owe Agenus a lot of money. $13 amount of money, $13 has agreed not to demand repayment anytime soon. They pay Wolf Greenfield a lot of money too. I guess their counsel is expensive. In January of 2025, MiNK executed a 1-for-10 reverse stock split. For every 10 shares an investor owned, it became a single share. Companies do this to artificially increase share price. While it makes the stock look more valuable, it doesn't change the underlying value of the company, which can be a bad sign. And here is the scary part. Nasdaq, the stock exchange, warned MiNK that their stock might get delisted. This is because their minimum value of listed securities was below $35 million for a while. Basically, they have been given a deadline to get their act together or risk being kicked off the stock exchange. So let's zoom out and look at the big picture. MiNK Therapeutics is trying to do something really difficult, create new cancer treatments. The raw numbers paint a concerning picture. The company is burning through cash, has significant debts, and is now in danger of being delisted from the Nasdaq. But is it all bad? Well, their close ties to Agenus could be a strength, providing them with some support and resources. This might be their way to hold on a little longer, but relying too much on related parties can also be a weakness. They need to prove they can stand on their own. Here's the truth. MiNK faces long odds. The risks are high, but if they can actually deliver a successful cancer therapy, the rewards would be huge. Alright, that's our deep dive into MiNK's latest filing. What do you think? Are they a diamond in the rough or just another company running on fumes? Drop your thoughts in the comments. If you found this analysis helpful, don't forget to hit that like button and subscribe for more corporate deep dives, and definitely join our Discord channel. Thanks for watching, and I'll see you in the next video.